Hello. Now, the US dollar index has lost 9% since March, and a lot of investors are questioning whether the US dollar will continue to depreciate and what that means for investment. We believe the US dollar has weakened for three reasons. Number one, the US economic performance relative to Europe and other developed economies are damaged by the COVID-19 pandemic. Europe's recovery fund was important to boost investors' confidence on Europe's ability to support growth. Number two, the difference between US dollar interest rates and interest rates of developed economies have also narrowed. 10-year US Treasury yields fell from 1.9% at the start of the year to 0.55%. Now, this makes holding US dollar cash less attractive. Number three, the improvement in risk appetite by investors reduced the demand for US dollar as a safe haven currency. Now, in the longer run, the US dollar should still come under pressure due to the low interest rate environment. We don't expect the Federal Reserve to raise interest rates in the foreseeable future, and it is also likely to engage in asset purchases to keep bond yields low. However, the potential for a second wave of outbreak in Europe and Asia could make investors more cautious again in the near term, and this could cap depreciation of the US dollar in the weeks and months ahead. Now, what does that mean for investors? In the short term, the US dollar may consolidate depending on how the pandemic develops in the US and Europe. But in the longer run, the prospects of a weaker US dollar should be positive for emerging markets and Asian assets, both fixed income and equities. Reduced currency risks should encourage more capital flows into Asia and emerging markets, as well as allowing central banks in the region to keep policy rates low. And also, a weaker US dollar typically happens when global growth is recovering, and this would improve the prospects of corporate earnings in Asia. We believe Asian investors should diversify their equity allocation to include more Asian equities.